Yeah. So let us. I want to ask your observation. Let us see what you would like to comment on this problem. Go ahead. What you have understood? Not audible.
Audible.
Naresh ji, are you speaking?
No, not speak.
Yeah. So please go ahead and say somebody can actually observe how this problem is different when compared to the previous one.
So the coupons per year are 2. So that would essentially mean that it is half yearly.
Correct. It is a semi-annual bond interest. Okay. So I'm writing it as a semi-annual bond interest, which means it pays once in 6 months. Okay. Interest payment will be once in 6 months. Next is any other observations?
It's 20-year bond, which is issued 10 years ago.
So which means there are 10 NPERs. NPER is 10.
Yes.
Okay.
And future value,
Redemption value is different.
Yeah.
present,
So normally what
present
happened in the previous problems, when the bond matures, you will get only the face value. In this case, you are getting some premium, some 30 rupees premium you are getting. That is the one more difference. Is it fine? Okay. So shall we solve this? So I'll solve this problem just in one step. So please concentrate. Okay. So what I do is I'll just go for price formula. Okay. So the settlement and maturity dates are there. Na? I'll just click on this FX. So I'll put the date in the date format. This is how I should be putting in Excel. So 2024, 1, 1, I am just putting it. And the maturity date is 10 years, right? So I'm adding 10 years to this 2034, I'll be making it. 1, 1. So the rate means what? The securities annual coupon rate it is. So the annual coupon rate of the bond I should be picking up. So coupon rate is 8%. So yield is 7.5%. And next is securities redemption value. For every 100 face value, how much I should put? I'll put 103.
103.
103, I'll put it. So frequency, how much should I put it?
2.
2, right? Because you'll receive twice 2 coupon in a year. Okay. So basis, next one is tab. Basis, I asked you to skip this. Let me also skip right now. Let's see. So I'll click OK. So I got this. So this I should be multiplying with 10. And this is the present value of the bond or the intrinsic value of the bond. So this bond I should be comparing with the current market price of 990. So the current market price of the CMP's current market price is 990. Okay, so can you tell me what is the decision?
Buy.
Okay, so we can actually buy this bond. So is it clear now comprehensively whatever we have discussed in the last class? Hopefully everybody understood this problem. Any doubts you can ask me. Supposing that if the coupons in the Muthoot FinCorp example, it was monthly, I can just make it 12 here if it is monthly coupon. Okay, so automatically you'll get the different answer.
So the price value actually gives the price of the bond for every year. I mean, the function of the price, what does it actually give that particular unit?
That is the value of the bond it is going to give you.
So N per we need to multiply by N per to get that particular value PV bond after maturity. Yes, sir? Isn't it so?
Come again?
I mean, we need to multiply with the N per to get the compare with the current market price. to get the PV of the bond because we multiplied with 10, right? So
multiplied with 10 because we have put the bond as if it is 100 face value, right? That is
okay,
it.
okay.
That is the reason we multiplied here by 10. That's it.
Okay.
Okay. So understood this valuation. Any doubts? Yes, madam.
No, sir, I don't have doubt. I just forgot what is coupon per year. I just want what did
Coupon
you
per year means how many times you will be getting coupons in a year. Twice means it is a semi-annual bond. Semi-annual means every 6 months you'll get it. Quarterly bond means you will receive the coupon 4 times a year. Automatically you have to put instead of 2, 4 there. If it is a monthly bond means you'll be receiving your coupon 12 times a year, which means the coupons per year will be 12.
Okay, so earlier we were solving with 1.
1, yes. Frequency was 1. Here we have put frequency as 2.
Okay.
So let us go to the next topic. So yield to maturity, that is in short called as yield it is. Okay, so it is in short called as yield it is. Let us see what is it yield. So it is used to measure the returns of the bond. Okay, so it is defined as the compounded rate of return an investor is expected to receive from a bond purchased at the current market price and held till maturity. Okay, so if you buy the bond at the current market price and if you're holding the bond till its maturity, what is the rate of return you'll be generating per year? Okay, that is actually called as yield it is. Okay, so please try to understand, it is the compounded rate of return an investor gets if you buy the bond as an investor at the current market price and if you hold the bond till its maturity. Okay, so what is the return you are actually making per year? Okay, so that is actually called as what? Yield to maturity. Okay, supposing that you go and buy a bond at let's say 800 rupees. Okay, and years to maturity is 10 years and it is the coupon rate is 8% and the face value of the bond is 1000 and you bought it for 800 rupees. So what is the return you have generated? If you want to compute this, then yield to maturity is actually going to be yield is actually something we should be computing. Understood what is yield now?
Yes.
Okay, you're buying a bond from the current market, from the secondary market. You will go out and what is the price you will check, you'll buy it and you hold this till maturity. After maturity, how much is the return you'll be making? Supposing that is what is the return we would like to compute this.
So what is the difference between the previous yield which we discussed, sir?
Previous yield, same yield only. We are discussing what is this yield.
So then what is
was-
the difference between the coupon rate and the yield to maturity, sir? Because if I am holding the bond for the last till the maturity, I will be getting the coupon rate value, right?
But
So how
what
is
if
it
you have
different?
bought the bond at 800 rupees? Your return will be more.
Okay,
Because,
I mean, you
because your
mean to say
redemption
that
value
when
will be
you,
1000.
okay, so if it is a secondary market, then it is a
Ah,
condition where
yes.
YTM will comes to play. Okay.
Yes. So
But
you
sir,
buy a bond from the secondary market and you keep the bond till its maturity. Maybe you must have bought the bond premium to the face value or maybe discount to the face value. We don't know. What is the return you have generated from the bond on an yearly basis? Okay, so that is actually called as yield. Have you understood now? Theoretically, at least.
Yes, sir. So
earlier,
YTM can only be calculated only at the end of the maturity, isn't it, sir? We cannot say in between, right? End of the maturity only we can calculate YTM.
No. The moment you buy the bond, you know the current market price. You can compute the yield at that point in time. Supposing today I want to buy some bond, I look at the bond's price. It is trading right now at let's say 950 rupees. 50 rupees discount to the current the face value. So I can compute right now, right? I have got all the I know all the values. Getting it? Okay.
Sir,
So
little bit confused. Yield and this YTM are same thing?
yeah, same. We call it as yield in short, YTM in full. We should have actually called it as yield to maturity, but we normally call it as yield only. Okay. So because we normally use, we don't call it as joint stock company, right? We just call it as company. That's it. Something like that. It is. Okay. So
Sir, one more thing, like it is written, it is compounded rate of return, but what we get is not compounded rate of return, what we seen earlier. 120 rupees per year we were getting.
Yeah, 120 rupees we are getting, correct.
So like, is this yield to maturity different in that case? What we studied earlier was not compounded.
No. So the value of the bond we have computed. Where is it we have computed to compounded return there? We have never computed compounded return there
Yes.
at all.
Yes, it was not compounded.
Yes. We have not computed the return at all, I'm saying. This is
Okay.
the first time with respect to bonds, something in return we are computing. So return means it is a compounded return, it is. Okay, normally simple return we don't compute at all in finance. It is in theory only, it is.
This PV and FV comes in picture in compound interest only.
Yes. The moment it is PVFP, it is by default compound interest only, it is. Okay, so YTM is that rate of discount rate which makes the present value of the cash flows from the bond equal to the cash outflow of the purchase of the bond, it is. Okay, so which means what we can see the current market price is your left hand side market price. So right hand side, what you have got is CT divided by 1 plus YTM whole raised to T. What is T? T is equal to 1 to N, it is. The coupon rate you keep on receiving, right? That is your first component in the RHS. The second component is the terminal value, which is also called as the redemption value. It is. Okay, which means you know what is redemption value, I did not explain, divided by 1 plus YTM whole raised to M. Okay, so your current market price should be equated with all the two components. Okay, that particular rate gives you the YTM. Is it clear, everybody? Understood? That particular rate is actually called as YTM. Okay, so the bond has a value of 1000, face value is 1000, the coupon rate is 15%, is currently available at 900 rupees. 5 years remaining to maturity, and bond is redeemed at par. So compute the YTM, which means you have to compute the yield of the bond. Let us take up this example. Just a minute. I'm just moving this to Excel. Hope the problem is visible. So the bond has
Yes,
a
sir.
face value. Face value is 1000. Coupon rate is 15%. And it is selling in the market at 900 rupees. Okay, so I'll write it as face value. So the face value of the bond is 1000. And the coupon rate is 15%. And the current market price of the bond is, it is available in the market, secondary market at 900 rupees. N per means 5 years to maturity. So we have to compute the yield. Okay, so let us go for the method, slightly lengthier one. So it is one, just a minute, I think what is stuck. So it is 5-year bond, it is. Cash flows from the bond is how much? You know that it is 15%. Always we have to compute on the face value, not on the current market price. You know it, right? So now what I do is I'll just drag it to the bottom, and I'll add what is the redemption value? Redemption value given as it is going to be expiring at face value, which means we receive 1000. Okay, so what is the present value of the bond? We have to compute this, right? If we know this only, we can compute this, right? Otherwise, we will not be able to compute this. Are you understanding my difficulty now? We have to compute this YTM now. YTM means this yield we are taking as 7%, 8%, some percentage in the previous problem, right? So assume that 8% is the YTM yield. Don't ask me, sir, how you got 8%. You tell me if it is 13%. If you feel that it is 13%, let me take 13%. Or if you say that it is 9.5%, sir, you take 9.5%. Just you can take any number here. That's it. Some positive number you take it, and let us solve. Assuming that that is our coupon rate. So sorry, that is what is our yield to maturity. So rate is 9.5%. It is our assumed, not the precise one. NPER is 1. PMT skip, future value is 150. So what I did is, until this, what we did, right? We have been doing the same for the last 60 or minutes or so. Okay. So how much would have been the current market price? Current market price should have been 900, right? But it is 1211. So let us go, please concentrate now onwards. Go to data. Keep your cursor on 1211.18, this cell. Go to data, go to what if analysis, click on goal C. Okay, so it is F102 in my case. This is the cell automatically highlighted. So come to the next. We have to fix this value to what value? 900.
900.
900 it is. By changing the cell, which cell? This cell?
Percent.
Percentage, right? 9.5%, what we have actually put it. So I click OK. After doing this, you can see I click OK. Excel automatically computes as 18.2% as my yield to maturity. Okay, can you do similarly how I did it? How many of you understood? Just raise your hand, because this is first time I'm using goal seek. I don't know how many of you are comfortable with the goal seek.
Yeah, understood.
Understood. It is easy one, because we have taken so much of time in understanding what is the pricing or valuation of the bond. That is the reason it must have been easier now. Now, if you have understood this, this is actually called as trial and error method using goal seek function. Okay, but we have got direct function called as YIELD, yield. Let us learn this. Let us discuss this yield function. Okay, so I'll go for, as usual, FX. I'll click on FX. So settlement is how much? I'll just take today's as if it is 2024, 1,1. It is a 5 years bond, right? So 5-year bond means I'll just put it as date. Sorry, I'll put it as date 2029, right? 5 years bond it is. 1,1. Rate is how much? Coupon rate, right? Securities coupon rate is 15%. Securities price per 100 face value is how much? I should put it here now.
90.
90.
90. Very good. So redemption is how much? How much should I put?
100,000 by 10.
Correct. So next is frequency is 1, because it's an annual status. So basis we are skipping.
So
And I
PR, why we selected 90? Sorry, I missed out.
PR is the securities price per 100 face value.
So how we got
Price is
this
900.
90?
90. For every 100 is 90 we are keeping.
Acha.
So basis we are keeping frequency 1, you must have understood. The redemption is 100, again, same. And frequency is 1. Basis is, we are skipping. I'll click OK now. You can just see what is the rate of percentage you have got it. It is same as what we have just computed using the tail end error method. That is the goal-seek function. Is it matching? 18.21 and this one.
So, sir, PR is equal to CMP. Whatever means like PR would be calculated on CMP.
Price per bond it is. So current market price we should be putting there. Is it clear, class?
Yes, sir.
Yeah. So yield to maturity we have understood as a concept, and I think this much is sufficient for you to understand regarding bonds. Fine. So we have discussed how to value the bond and what is the yield and how to compute the yield.
And sir, we basically avoid basis, right? In this case.
Okay, I'll explain you since you've asked me.
Because every time I do it, basis, you have to just
Yeah.
keep it
So
as
let
it
us
is.
understand what is basis actually. Okay. So help function. You can see if you put 0 in basis, you're taking 30 by 360. This is what normally used in US, which means that there are 360 days in a year and 30 days in a month. Fix, you'll be taking it. If you put 1 means what? Actual by actual. We are using 2024, right? In 2024 is a leap year. Leap year means there are 1 day extra you'll be getting in February. That is the reason it is actual by actual it is. Okay. So next convention is 2, actual by 360. Which means I am considering that there are 360 days in a year, but not 366 or 365. That is the reason you have to put 2 there. Next is if you put basis 3 there, actual by 365 it is. Okay. So if you put basis for European 30 by 360 it is. See, if you are there, which region you are there, you have to go by that actually. So because you are buying a bond, not one bond, it is 1,000. Don't think that you'll be buying 1,000 worth of a bond. It is only one bond you'll be buying. Normally, if you're an institutional investor, you're actually investing into the bond will be crores of rupees. Okay, our minimum will be 500 and maximum will be around 80 or 90,000 crores it will be. For 80, 90,000 crores, even 1 day also makes a difference. Even 1 day calculation also makes a difference. Okay, if you put 0, 1, 2, 3, 4, whatever the basis you're going to put, you get the same answer because you are actually investing only 1,000. For 1,000 rupees, that does not make any difference. Okay, put 1 lakh crore, 90,000 crore and see the answer, you will be having a different answer because that is actually going to be altogether different because 1 day also counts. 1 day also makes more sense. See, if you really see what we have put here in the Excel is okay. So I think you have understood what is basis now.
Right, sir.
Okay. So that is actually not causing much of a difference for us. That is the reason we excluded discussing basis. If you just don't put anything, I think it will take some 0 as an basis there. 0 is 30 by 360. Okay. In India, normally we go by actual by actual. So you can wherever which geography you are located, you can think of putting that as a basis. Hope that is sufficient.
So actual by actual means the actual maturity period divided by what actually?
No, in 2024, if I put there is a leap year there. It takes one day extra for that particular year.
So in actual by actual, it will also count the leap year.
It will count leap year as is.
Yes.
2024 as a leap year, 2025 as a non-leap year, 2026 as a non-leap year, and so on. Clear?
Yes, sir. Thank you.
Okay. So I'm just saving this sheet and I'll be sending this sheet once the class gets over. Is it fine? And I also share this PPT. because normally we take 5 to 6 sessions to complete whole of the bond pricing valuation of bonds. There are many things which are there here, which may not be applicable to your class, because it's a completely comprehensive PPT which I prepared. Okay, normally I use this PPT for PGP students, where they'll be having investment analysis and portfolio management as a 30 session class. Okay, for them I prepared this, and for you I have just gave you the very basics of it. So how much ever you will be able to understand, you can grasp so much, only so much you can actually go through this particular PPT. Okay, so I have covered till YTM. You can only, if you're interested, only such until such time, you can only we can only concentrate only on such so much only. Okay, no, don't bother beyond YTM in that particular slide. Okay, so let me go to the next one. So the next one, what I'm going to cover here is the introduction to risk and return. Yeah. So please concentrate. We'll be discussing from now onwards the risk and return, which is there for your session 5. Okay. So what are investment returns? Normally, if you ask me what is investment return, you invest today and you are there said invested for let's say 10, 20, 30 years, whatever it is the time horizon. Whatever the returns you have generated, you would like to compute the returns for your holding period, right? So that is actually called as an investment return. Investment returns measure the financial results of an investment. So it is actually going to tell you how much is the return you have generated on your investment, right? For that, we have to know how to compute the return. We should be knowing it. Okay, in case of bonds, we have just now discussed how to compute the investment return through yield function, right? So returns may be historical or maybe perspective. That is anticipated return. Okay, so I have invested around 5 years ago. Okay, so I have made an investment. I have made an return of, let's say, 20% CAGR. That is compounded annual growth rate. So that is actually going to be called as historical return. It is understood. What is historical return? It is.
So please repeat.
Historical return means I have invested in XYZ company. Assume that I invested some money in a stock. Okay, so that stock is Reliance Industries. I bought it at 2,000 rupees when it was trading at 2,000. Today it is trading at 3,000 rupees. After 5 years, it is trading at 3,000 rupees. Okay, so if I compute the return, that is actually called a historical return, right?
Okay.
Supposing that if I expect right now Reliance Industries at 3,000 rupees, I am expecting that Reliance Industries may move up to 4,000 rupees in next another 5 years. What is the return I can actually make out of it? It is actually called as an anticipated return, because you are anticipating that Reliance Industries from 3,000, it is going to move up to 4,000 rupees next 5 years. Okay, you are anticipating. Okay, so that is also called as what? Prospective return. That is actually called as what? Prospective return, or an anticipated return you're expecting. Many people will be doing it, right? So if I invest in stock market, my return will be how much? So I can double just in 1 year's time. That is actually called as what? Anticipated returns, right? So returns can be expressed in rupee terms, or it can be expressed in percentage terms. We will discuss both of them. So we are discussing very basic with respect to return in this particular session. And there are 2 sessions which we'll be discussing about risk and return. The first one is today's, that is 5th session, and 6th session is going to be next week. We'll be discussing risk and return. Okay, so tell me, what is risk? Because we are discussing return is understood. What is risk now?
So deviation from expected results, the degree of
Deviation
deviation.
from the expected return.
Degree of uncertainty.
Degree of uncertainty, yes. Okay, so there are various various people say various things about risk. Let us see, for investment sake, what is actually called as a risk. So risk is, in traditional terms, is viewed as a very negative, in a quite negative way it is. Okay, Webster's dictionary, for instance, defines risk as exposing to dangerous hazard. Okay, the Chinese symbol for risk reproduced below gives us a much better description of risk, at least with respect to investments. Okay, so you can see you'll not understand what is this symbols are actually in Chinese. Let us decipher what are they actually. The first symbol is a symbol of danger, it is, and the second symbol what you're seeing is opportunity. Okay, which means what? There is a danger, but you have to view that as an opportunity, because if you take risk, then only you can actually achieve something in life. You must have seen this particular quotation, right? It is actually applies to the risk here in finance as well. Okay, there is a risk, there is going to be a danger, but it should be viewed as an opportunity, because higher the risk, you know that higher the return. That is what is actually going to be in the real life situation as well, right? So let us go through now. So typically investment returns are known with certainty, which are not really not known to us in certainty, right? With respect to bonds, we can say that returns are actually certain, because these are actually fixed income bearing securities. But when it comes to stock, we may not be knowing what is the return this particular stock will be generating in the next few years or so. Investment risk pertains to the probability of earning a return less than that expected. Okay, supposing that you felt that if I invest in Reliance Industries, I can make 20% a year. But after 1 year, you understand, you computed, and you the return, what is it you actually got is 15%. You expected 20%, but you ended up with 15%. There is a difference of 5%, right? Even that 5% is also termed as risk in finance. Okay, what you anticipated and what is actual, and difference between that is actually termed as risk. Okay, somebody also pointed out this before beforehand only. The greater the chance of return far below the expected return, the greater the risk. Okay, so let us now understand what is holding period return. So please concentrate from now onwards, because theory is over now. Now we are actually using Excel to compute certain real life situations, right? A key measure of investor success is the rate at which their funds have been grown during the investment period. Okay, the total holding period return of a share of a stock depends on the increase in the price of the share over the investment period, as well as any dividend income share has provided, which means you have got to have two types of return if you have invested in the stock. One is the dividend return, the other one is the capital appreciation. What is capital appreciation? In simple words, if you have invested today at 100 rupees one stock, that has doubled in just in 1 year's time, which means at the end of the year, the market price has grown from 100 rupees to 200 rupees. So what is the capital appreciation in this case? 200 minus 100, which is equal to 100 rupees is the capital appreciation. Understood what is capital appreciation now? 100 becoming 200 is actually what? The 100 rupees extra growing in just in 1 year's time is actually called as what? The capital appreciation is. Assume that you have got some 10% dividend as well. Okay, so 10% means assume that you got the face value of the stock was 10 rupees. Okay, and you got the 10% return means what? 10% on 10 rupees is 1 rupee. So 1 rupee is the dividend income you got. Okay, so dividend return and the capital appreciation, both if I add, I got to have something called as holding period return. That is as simple as that. Fine. So there is an equation here, what I have just now told you. Ending price is how much in our example just now given?
201.
200 minus beginning price was?
Sir, just one question. Means,
100.
that was the capital appreciation or something? What
Yeah, capital
was the
appreciation, I said you begin with 100. At the end
no,
of the year,
capital
it was
appreciation?
200.
I just want capital appreciation. Is it
Capital
down?
appreciation.
Okay.
Capital has been got appreciated. That is why we call it as capital appreciation. So ending price was 200 minus beginning price was 100 plus cash dividend you received is 1 rupee divided by beginning price was 100. You can easily compute how much is HPI, that is holding period return. Okay. So this definition of HPR assumes that the dividends are paid at the end of the holding period. Okay. So I'm skipping this. So we can just see this example. Can you compute this? Very, very simple problem it is. Suppose you have invested some of your money in Kotak Nifty ETF a year ago when it was trading at 100 rupees. At the end of the year, you also received a dividend income of 4 on this fund. If the current market price of this fund is 110, how much is the HPR?
14.
14.
Yeah, so 110 minus 100 plus 4. So 10 plus 4 is 14. 14 divided by
14 divided by 100, 14%.
14%. So you need not to compute any Excel. So understood now what is holding period return, everybody? Any doubts?
Sir, why are we dividing it by again 100 as per the formula itself? But the return is what we are subtracting, and then we are adding the interest. So it should have sufficed the purpose.
No, we wanted to express in percentage terms. So that is why we are dividing by 100.
Here are no, otherwise also in formula, just in the previous slide. Beginning price we are dividing. That is what I want to ask. Why we are dividing it by beginning price?
No, you don't divide. If you don't divide, you will not get the percentage return.
It will be fraction. You can
Okay.
multiply this with that.
To
So
get
if
the
you don't
value,
divide, yeah, go ahead.
to get the means FPR in value, we have to go for ending price minus beginning price plus cash dividend. If you want to calculate in the percentage, in that case we have to divide. Is it so, sir?
Nirankar, your voice is breaking. Whether you're explaining or you're asking question.
Yeah, I was asking, sir, means when we will calculate in terms of the value, in that case we will not divide.
Correct.
And when we have to calculate in terms of percentage, at that time we have to divide by the beginning
Yes.
price.
Yes. That is as simple as that, right? Because we started with 100. How much is this? How much is the return you have generated out of investing 100? So that is actually going to give you the percentage return, right? So if you divide by beginning price, you will get to have the percentage return. Okay. So can you now bifurcate dividend yield and capital gain yield in this? Quickly tell me. Suppose a stock had an initial price of $80 per share, paid a dividend of $2.45 per share during the year, and had an ending share price of 104. Compute the HPR. So you can easily compute the HPR. Can you tell me how much is the dividend yield and how much is the capital gain yield in this problem? If I ask you differently, how do you compute that is? You will take 2.45 divided by how much you started off with 80. 2.45 divided by 80, if you do it, okay, you get to have a dividend yield. If I ask you how much is capital gain, then what you do is it is 4 divided by 80, you will do it, so that you will get to have a capital gain yield. It is as simple as that. And if you add both of the returns, you will be having HPR. Is it clear?
So
Wait,
one doubt, you mentioned that the capital gain yield would be 104 minus 80, that is 24 by 80, right?
Oh, sorry, 24. No? Sorry, I confused it 100. Okay. So it is 104 minus 80, it is 24, right? So 24 divided by 80, it is
30%.
Yeah. So you will do this problem once I give this slide to you. So I'm just skipping, it is quite basic, it is. So let us go for the nominal rate of return and the real rate of return. Okay, so tell me what is nominal rate of return? Anybody knows this?
Sir, non-inflation adjusted rate,
Yeah,
and we do not take inflation into account.
correct. So you go to the bank and you have got a 1 lakh rupees and you would like to make a fixed deposit for the next 10 years, or you want to make it fixed deposit for the 1 year. Okay, so 8% is the rate of interest which the State Bank of India is quoting. How much is your nominal rate of return in this case? 8% is the nominal rate of return. Which means whatever the bank has quoted, 8%, that is your nominal rate of return. What is the real rate of return is you check the inflation rate in the economy. Assume that the economy in the Indian economy right now, the inflation, assuming that it is 7% right now, What is the real rate of return? Nominal rate is 8%, which the bank is quoting for a fixed deposit, minus 7% inflation rate in the economy. Okay, so approximately your real rate of return will be 1%. I will not say exactly 1% because there is a formula for computing the real rate of return, which I'll be explaining you right now. Approximately how much is your real rate of return is 8% minus 7% is 1% will be your real rate of return. Understood, everybody? What is real rate of return? It is the inflation adjusted return. It is. If your bank is quoting 8%, inflation is going to eat away 7%. 8 minus 7 will be 1%. Approximately 1% will be your real rate of return. Okay, how to compute this real rate of return? Real rate of return is equal to 1 plus NR divided by 1 plus IR minus 1. Fine. So what is NR here? The nominal rate expressed in the decimal terms. And IR is inflation rate expressed in the decimal terms. Okay, you get to have this information. Okay, so calculate the calculating the return. Suppose you bought 8% coupon bond 1 year ago for 1056. Okay, the bond sells at right now at 1090 today. Assuming that 1000 is the face value, what was your nominal return on this investment over the past year? If the inflation rate for the last year is 3%, what was your total rate of return on this investment? Sorry, a real rate of return on this investment. Will you compute this?
$2.57.
Okay, so I just copy this.
Yield minus 3%.
4.8. 4.8%.
1.57.
I'll just copy this. Okay, suppose you bought this time. Okay, suppose you bought 8% coupon. So coupon rate is 8% given in the problem. 1 year ago, which means N per is 1. Okay, at what price you bought this? Buying price is $1056. So today it is selling at what price? Assuming that you're going to sell at 1090, right? So face value of the bond is $1000. Okay, so how much return you have made on this? Since you must have received a coupon, right? So coupon will be how much? It is 8% on 1000. You received the coupon. So capital appreciation is how much? So the capital appreciation is, it is 1090 today, but you bought it at 1056, right? There is a $34 profit on the capital appreciation. So if you add both of them, it is 1014 it is. So 1014 you have got it on how much investment? You bought it at 1056, right? So you made a return of 10.79%. This is the nominal rate of return. How many of you got 10.8? Just straight yes in your chat box. Let's see how many are listening. Okay. So 10.80, fine. How many did not get 10.8? Just put it as no.
I got lost in between.
So
I was listening to you simultaneously. At times, when we start to calculate, neither I am able to understand there nor it gets solved. So at times, I just see how you are doing it.
It happens that
Okay.
toggling between the sheets, you get stuck in between.
Correct. So fine, it happens, but overall, if you understand what I am explaining, that is sufficient, because you can go back and you can because I'll be sharing all these Excel sheets and you can easily get to know all of this. It is fine because I'm not giving you ample time also to compute. I know, I do understand, because of the paucity of time. Please don't mistake me, because if I give you a chance, what happens is we'll be wasting so much of time and we may not be able to achieve the objective of the class. That is also very important, right? Okay, so that is the reason at times I'll be slightly faster. Don't take me wrong. So 10.8, you'll be getting this. Hope you understood how we got this 10.8. This is just the return, and this is actually called as nominal return. It is.
Yes, sir.
Okay, so can you tell me how much is inflation given in the problem? Inflation rate is how much?
3%.
3% given in the problem. So 3% is the inflation. So can you now compute the real rate of return using the equation given in the last slide? I'm just copying for you here.
Minus 3%.
Just a second. So this is the equation we should be using for computing the real rate of return. Okay, so okay, so what is real rate of return? This is the
1.95.
yeah. So I'll just compute this now. Real rate is equal to 1 plus NR means nominal rate, which you have just now computed. Okay, so divided by 1 plus IR is inflation rate, it is minus 1. How many of you got the same answer as mine?
Yes, sir. 7.5.
Got it, sir.
So this
In
is
the
how we should
formula, it was
compute.
mentioned 1. In the formula, it was mentioned 1 plus NR divided upon 1 minus IR. But we are using 1 plus NR and 1 plus IR.
Am I wrong anywhere?
Sir, dividend should be 1 minus IR. 1 minus.
Come again.
As per the formula, real rate of return is equal to 1 plus NR divided upon 1 minus IR.
Where is
You are
minus
using
IR is interest rate, IR is interest rate. Inflation rate,
interest rate? Inflation rate it is.
Inflation rate.
No,
1
I am
plus
saying
only. Here you can see 1 plus IR.
Correct, sir. Done.
Done, na? Easy it is.
Yes.
It is very easy one. So arithmetic and geometric returns we'll be discussing. This is very important from the standpoint of practicality. Okay. So to make you understand what is arithmetic and geometric, we have got a small example here, simple example. Suppose you bought a particular stock for $100. Unfortunately, the first year it falls to $50. From 100, it falls to $50. The second year you continue to own it, it raises back to $100, leaving you where you started. Assume that no dividends are paid in between. So what is the return you made on this investment? Can you please tell me what is your answer? You can just put it in the chat box. Don't tell me here. Just put your answers in the chat box. So Abhishek is 0%. Vikram is saying 0. No, this is a different concept. Forget about real rate of return, at least for time being. Okay.
Inflation percent loss.
No, inflation we have not given in the problem. don't consider that now. So negative return, some are saying negative return. If you don't consider inflation, real rate of return, just tell me the nominal rate of return. Nominal return, many of you putting 0, right?
Yes, nominal 0.
Because it's quite commonsensical. You started with $100 and you ended up with $100.
So there is no change.
So there is no change. That is the reason you are saying that is 0%. If I ask you the same question
Yes.
for MBA students, they'll come out with one more answer. Okay, that $100 came down to 50. How much return you have generated?
Negative.
Minus 50%. Minus 50% for the first year. Second year from 50, it rose to 100, which means there is a plus 100% return. So if you take average of it, how much it will be? 100 minus 50 will be 25%, right? Average for 2 years divided by 2.
Yes, sir.
So minus 50% return for the first year. Second year is plus 100. 100 minus 50 is plus 50. Plus 50 divided by 2 is 25%. Getting it now? Now your common sense is that where is the 25% return? Because in my hand, nothing is there actually. I started with $100, but I ended up with $100. So your common sense is telling you that there is no return at all, 0%. And if you consider inflation, again, your return will go into negative. Real rate of return will go into negative, right?
Yes.
So then what is the right answer here?
Sir,
Tell
0,
me.
sir.
Practical answer is this
because
only, sir. There is no change.
Because the formula you just said about minus 50 and plus 50 is not that, sir. It is A percentage minus B percentage minus AB percentage. So that equals to 0.
Okay, answer is both are correct.
0 is correct.
Because you just answer different questions. The 0% you called, it is actually called as geometric return. Okay, and 25% what you got is an arithmetic average return. Both are correct. But which one to follow? You know which one to follow, right? Geometric return makes more sense in finance because that is actually going to be more intuitive. At the same time, normally investment returns should be computed with the geometric return, not the arithmetic return. Okay, so geometric return is also called a CAGR return. How many of you invested in mutual funds and you got to know that what is your return is XIRR? Yes, Naresh Kumar, can you please go ahead and explain?
This is equivalent to CAGR, compounded annual growth rate.
Yeah, so CAGR is equivalent to geometric return.
Yes.
Okay, geometric return is in one more terminology called as CAGR return, compounded annual growth rate. Okay, both are same. Okay, so can you now compute this problem? Go to your Excel and compute this. Compute arithmetic return and geometric return, both. For arithmetic return, I am not giving you any equation for you. It is 8 plus 12 plus 14 plus 17 plus 20 plus 26 divided by number of observations. 1, 2, 3, 4, 5, 6. You'll get arithmetic return. Fine. Geometric return, I have given you an equation there. Okay, so I'll solve along with you. Okay, you keep solving it. Okay, Abhishek Sharma has given answer 15.175%. Okay, so let me compute arithmetic first. Arithmetic return is equal to, it is 8 plus 12 plus 14 plus 17 plus 20 plus 26. So divided by 6. Is it correct?
Should be 16.17%.
Yes, sir.
You have to put in a bracket, sir. All the addition you have to put in a bracket.
Correct. So board mass.
Yeah, board mass.
16.17% is your arithmetic.
Yes.
So can you now
16.1.
quickly compute geometric? So what I do is I'll just returns, I'll put it here. It is 8%, 12%. Please put it in percentage terms, otherwise you'll get wrong answer. 8, 12, 14, 17, 20, 26. So let us go by the formula now. What is there in the formula? I should add 1 to this, right? I'm adding 1 to this. Then, so I have to multiply this, right? Multiply. Next is what? Whole raised to
1 by n. 1 by 6.
1 divided by 6, right? And then minus 1, right? Are you getting the same answer as mine?
Yes, sir. Same answer.
So what is the class timing until 8?
8:30.
8:30, sir.
9 minutes more.
8:30. So let us do till 8:35. Is it fine?
Okay, sir.
So now you've understood now what is geometric mean, how to compute this. So now can you compute Tata Motors return for the last 5 years? Geometric return. Let us do something practical. So I'll go to Google Tata Motors historical data. So I'll go to investing.com, Tata Motors historical data. You can just see what I'm doing right now. Later on, you can do the same. Okay. So I would like to compute the historical return. Okay. So what I do is I'll go for a weekly data. You can go for daily or monthly, whatever it is. I'm going for weekly data. So concentrate what I'm doing now. I'll take from 2019 onwards. Okay. And I click apply. So I got my data here. It is weekly data, right? So I'm just copying this, whole of these values. Now I'm going to Excel sheet now. So I copy pasted it. You can see there are many prices are there. So I'll only keep a price here. Price means it is the last price it is. Closing price, weekly closing price. So I delete everything else. Can you see this? April 21st, 2024 data is available here. Okay, so let us go down. April 28th, 2019 is 209.45 it is. 209.45 has grown up to 999.5 rupees. Okay. So, but I want to rearrange this particular data upside down because I want last, that is 2019 April 28 data should come first, and this particular data should come last. What should I do now? For
Price.
pardon?
So you can sort it
Task.
on.
Okay, so I'll put sort now.
Sort and data.
So which means I have to go here, Z to here, right?
Z2.
But Z to here, if I do it, you can see 20, 21, 22, everything is club. It is not happening.
On the basis of date, we can select. No?
No, it is not happening. No?
Yeah, so because this date format data is actually
Right.
general format, you see. It's not actually date
Select.
format for Excel language.
Correct.
We have
So
to
what
put
shall we do
date.
now?
Yes.
Can
So
you
you
fix
have
this
to select
problem?
both. You have to select both date and price, and filter should be on the price.
Filter should be on the price.
No, that way it
first,
gets sorted
plus
price.
first select both row, sorry, both column A and B, and after that apply filter on the price.
Okay.
So
So
we can do one thing. We can copy that particular column and we can paste it again as text wizard with a comma separation. Will create two columns. One will be having dates and one will be having year.
hope that is solved now.
Yeah, even though we can use as sensitivity analysis also.
Is it clear what I did? So I have actually put one more column, 1, 2, 3, 4, and reversed it. That's it. Hope everybody understood what I did.
No, so can you please
Yes, sir.
demonstrate it again?
Once again,
So I just put code 1, 2, 3, 4, 5, 6 till 261 I did. Then I went here, largest to smallest. Done. Is it okay?
Yeah, good.
So there are multiple ways of doing in Excel. So I just did the way I wanted to do it, or I know it in other words. Okay. So I did that now. So can we now compute the holding period return now? How to compute holding period return? You know it, right? So this is the ending price minus beginning price. Sorry, this is the 185.9 minus 209.45. Close the brackets divided by beginning price. Have you understood what I did?
Yes.
Understood, sir.
Today's price divided by yesterday's price divided by yesterday's price. Which means I am taking a weekly return. That's it. Because these are the weekly prices, right? Understood, everybody?
Right.
Shall I move on?
Got it. Yes.
So I
Yes,
just
sir.
double click on it now.
Sir, I did not understand.
Okay. So I delete from first. Let me do from first now. Is equal to, this is 2019 May 5th. Supposing if I want to compute the return for May 5th, how do I do it?
Sir, we are calculating HPR, right?
HPR without dividend
Okay.
is equal to this minus this divided by this. And I
Yes.
have to keep this in the board mass rule. That is brackets. Somebody alerted me.
Yes.
Okay. Same, simple it is. Today's price minus
Yeah, I
yesterday's
got it.
price divided by yesterday's price, or ending price minus beginning price divided by beginning price.
Yes.
So I did it in one cell and I'm going to copy for rest of the cells. So I have computed weekly returns for all the 261 weeks now.
Yes.
Okay. So tell me what is there in the formula, CAGR formula. I'm just keeping it here for your reference.
Average for
Plus 1 we have to do.
Plus one in each interest.
These are our R1s, R2, R3 and Rn. Till Rn it is there.
Yes.
So is equal to this plus what?
Plus 1
Plus 1.
power
So
1
for
by
this,
261.
we are going step by step.
Okay.
So we are just adding 1 because R1 plus 1, R2 plus 1 in the formula you can see here. Here.
Yes.
I press enter. Now I double click on this. Done. Now I should multiply whole of this and raised to 1 divided by n I should do. So obviously I can't multiply 161. Is there any shortcut? Anybody would like to tell me that?
Some product.
Is equal to product.
Some product.
It is product, it is not some product. So I'll copy whole of this and press enter. So my product is ready. Clear? Understanding what I did?
Yes.
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 Product is equal to whole of the series. Now what should I do now? Is equal to this product raised to
1 by number of
1 by 2.
1 divided by count. Is it clear, everybody?
Yes, sir.
Yes.
What should I do next? I'm going step by step. This minus
1
1
Minus 1.
what is this?
into 100.
What is this?
Weekly return.
Weekly. What we
0.6%.
require?
Annual return.
We
And
require. So how to compute annual
multiply
return?
multiply by
1 into 52.
52 because there are 52
Weeks.
weeks in a year. How much is a CAGR return we got it?
31%.
How many understood? Please write it in the chat box. Yes. Okay. So fine. So many of you understood. Okay, good. So this is how we should be computing the CAGR return when it comes to stocks, because we have to convert them into the weekly return. Weekly returns into the CAGR returns. Shall we discuss shortcut now?
We take
So just one
starting
question.
only we can
Suppose
take the annual.
So just a question. If
Yeah.
share price is getting doubled in 1 year,
Yes.
so what will be CAGR? 100%?
So share price from 100 rupees, it went up to 200.
Yes.
You compute the CAGR and tell me now. Okay, so I'll just go through the shortcut. So geomean, can you see this geomean? Can you see this geomean function?
Yes, sir.
Select this
Yes, sir.
geomean for this series, that is +1. Close the brackets, -1. Okay, so you can actually escape using product function.
So please show again.
I'll show you.
Metric mean, right?
Geometric mean it is.
Geometric mean.
G is equal to geomean, and then select whole of the series, +1 series, -1 again. And I'm giving you a caution, this geomean function works sometimes it does not work. So that is the reason I have explained you the long method as well. You know how to do with the long method. Okay, supposing if it is a daily return, how to do it? How do you do it? Everything else is same. Multiply with what?
7.
360.
365.
252. Because there are 252 trading days in a year.
Okay.
That is
Okay.
that is one thing you should be doing it. Because Saturday, Sunday, holiday. So 104 days gone there, right?
There are
And
other
suppose
holidays also, sir.
if you
Pardon?
There is holidays of 2nd October, 26th and 15th August, sir. Those holidays, sir.
Yeah, so approximately, I'll tell you what is the global standard. So normally they multiply 252. They'll not consider any other holidays. So let us also follow 252. Is it fine?
So just
Uh,
one
suppose-
question on the basis of practical use. Any is it a thumb rule we can always go for geometric mean, or somewhere arithmetic mean would work over geometric
For
mean?
finance and investment, it is only geometric mean. Okay, but in the mutual fund fact sheet, what they do, instead of using geometric CAGR, XIR, sometimes they'll use average return to mislead the investors. Please be very careful about those things. Okay. If somebody raised yes, Nirankar, please go ahead.
Yes, sir. Suppose if you want to calculate the CAGR of a company, suppose for 2019, the sale was 200, then sale becomes increased next year by 300 CR. So in that case,
Nirankar, your voice is breaking and I'm unable to hear actually.
I'm saying, suppose if you want to calculate am I audible right now?
Your voice is breaking actually. Can you take this offline if you don't mind? You can just mail me. I'll answer to this question.
Sir, what is full form of XIRR?
XIR is a CAGR in Excel. I'll explain that as well. Okay. We will discuss that IRR when we go to investment.
Sir, I have one doubt. We have
Yeah.
initial price and we have final price. Why we cannot calculate the direct?
Yeah,
Better.
you can do that way also, because if you really do present value is equal to future value multiplied by 1 plus R whole raised to N. Okay, so this is the equation everybody knows by this time, right? So if you solve for this R, okay, then what comes up here is, so present value divided by future value. Okay, and next is it is there in the raised to 1 divided by N. Okay, 1 divided by N minus 1. It is not N minus 1, it is minus 1 separately. Okay, you can use this for, this is also one more method of computing CAGR. Okay, but I would rather prefer this one. You can just see what is the value you are getting. Okay, what is present value here? This is present value and this is future value. Okay, and N, everything else you know it. Only R you don't know, you compute R. Okay, so this is also one of the equation. Normally, some of them use it, but the more comprehensive one is this one we just now we discussed. Is it fine? Okay, so shall we close the session, class? Anything else discuss?
Sir, I just put the question in chat box.
Okay. Sale is for 2019 is 300 crores, 2020 which is 400, 2021 is 150 crores, and yeah, what calculate CAGR? Yeah, same as what we have just now discussed. Okay, but if you have got difficulty in doing this, since this is very time consuming, so you can use this formula right now. I just give PV is equal to FV divided by 1 plus R whole raised to N minus 1. This one, sorry, PV divided by FV divided whole raised to 1 divided by N minus 1. Okay, this equation you can use it for smaller what is it, differences. For smaller problems, less than 10, you can use this directly. What Naresh has actually expressed. Is it fine?
Yes, sir. Please share this file also, sir.
Yeah, definitely. It is for you. It is.
Thank you, sir.
Yeah, bye. We'll meet in the next week.
Thank you, sir.
Thank you, sir.
Thank you.
Yes.
Thank you, sir. Have a nice week. Have a nice
Thank
weekend.
you.
ahead.
Thank you, sir.
Thank you, sir.
Bye.